if you don't want to worry about the volatility in the price of gold or silver, and you know that gold and silver are going to move higher in price, then just buy physical gold and safekeep it yourself. You're not buying physical gold and silver as a speculative investment. You're buying physical gold and silver as an insurance policy.
Please join us for our next live stream Sunday, July 31st at 9 p.m. Eastern. We'll go over current events, past guests, and of course, gold and silver news. Once again, our next live stream will be Sunday, July 31st, 9 p.m. Eastern. See you then. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. Dave Kranzler from InvestmentResearchDynamics.com joins us today. Dave has over 30 years of experience researching and investing in the precious metals markets. And Denver Dave is also a hedge fund manager, has worked on Wall Street, and was a junk bond trader. His Mining Stocks Journal and Short Sellers Journal are two of the go-to subscriptions for investors in the mining sector and equities. And we are delighted to have Denver Dave Kranzler join us once again today. It's time to saddle up and silver up for Dave Kranzler. Dave, welcome back to SBTV. How are you doing?
Hey, thanks for having me back on, Patrick. It's good to see you.
Good to see you also. Glad to have you back again, Dave. You know, I want to start with the health checkup. No worries, buddy. No rubber glove here. It's an economic health checkup. If you could you describe what the VIX index is and what the MOVE index is, as some of us may not be familiar with the MOVE index. So we'd like to kind of get an understanding of what it is.
Sure. Well, I mean, the VIX just simplistically measures, it's called a fear indicator. It kind of measures the degree to which investors are using puts versus using calls. And it, I mean, it's commonly used to assess investors' appetite for risk in the stock market at the current time. I think it's as much a backward looking as it is a forward looking, because I think there's implied volatility factored into the equation. It's complicated options based mathematical equation, and typically when the VIX is at a low level, say below 20, or it goes into the mid-teens, that usually is correlated with a rising stock market. And then when the stock market starts to get volatile and headed down more than it's headed up, then the VIX starts to rise. So, and then typically there's periods of time where you'll see the VIX spike up into the 70s and even as high as the 90s when you have market dislocations like we had in 2020, March 2020, and December 2018. I think it got into the 70s. And certainly in 2008, I think it hit as high as 95. So, and currently it's at 23. So it's higher than it has been on average for the last 10 years. But it's been trending higher, and I think it got into the 30s in the last couple months when the stock market's had some sharp drops. So that's what the VIX is. I think everyone's probably familiar with that. There's all kinds of ETFs or ETNs or whatever you want to call them that let you speculate on either directly on the VIX or inversely on the VIX, and then various levered ETFs that let you do the same thing with leverage. So the MOVE index, again, simplistically, it's basically just the VIX for the bond market. And when it's rising and rising rapidly, it means more than likely that bond prices are falling, interest rates are going up, and there's a much higher degree of perceived risk associated with the credit markets, especially with corporate bonds and mortgages and fixed income products outside of treasuries. And when it's falling, the MOVE index actually started rising in early 2021, And from a lot of the economic analysis and financial analysis I do, I really felt like corporate credit quality and the economy itself was starting to deteriorate last summer, in August, September. And the move index, just looking at, let's look at a 5-year chart here. So, yeah, the move index started moving up sort of in a steady fashion in early September. So, and it was at an index level of 56. And recently it's been as high as 144. And it's dropped down the last few days with the big move higher in the stock market. And also, interest rates came down. The 10-year came down from 350 to, it was below 3% for most of this week. And so far, and I guess that was kind of, the perception of risk kind of eased up a bit. So, but to put that index level in perspective, the chart I'm looking at is on tradingview.com and it goes back to 2023. The move index in late 2008 hit an index level of 214. Okay, and again, it's at 122 right now. But the level that it's at right now is as high as it's been going all the way back to early 2009 when it was coming down from that 215 level. And actually, if you want to look at it when the VIX was rising the way it's been rising now, because it started to rise, well ahead of when the stock market started catching up with how risky the entire financial markets and credit markets and banking system had become. If you recall, it was, the equity market didn't really start freaking out until Bear Stearns went bankrupt. But so the last time when the VIX was rising above 100 the way it is now at this level was, let's get this right here. You got to go all the way back to November 2007. And that there was a lot of signs that there was going to be market turbulence ahead of us back then, and this was certainly one of them. And I would argue that right now, this is flashing multiple red signals that something is wrong in the global financial system and the credit markets, and we can point fingers at a lot of different things. So, and that's also been translated into the turbulence that we've seen in the stock market. And obviously the stock market, at least in my opinion, became more overvalued by almost every possible measure than it has ever been in history. So that's kind of the move in a nutshell.
Yeah, I completely agree with the overvaluation in the stock market. Dave, since we're talking a bit about bonds, there were some people who were saying that the Fed was going to have to implement yield curve control. Do you think they've actually tried to do that already, or is that still in the cards for them to try and work in?
That argument and that and that narrative drove me nuts because the Fed's been implementing yield curve control since 2008. I mean, just by the fact that they started buying massive amounts of treasury bonds all along the curve, all the way out to 30-year treasuries. The Fed is by far the largest holder of 10-year treasuries. And guess what's priced off 10-year treasuries? Housing mortgages. But just the very act of buying the Fed, a central bank buying the risk-free bonds issued by the sovereign entity tells you that, and especially for the Fed, because pretty much everything in the rest of the world kind of prices off of the US Treasury market, the US Treasury curve, or LIBOR, of course. So just by the fact that they've been buying, they bought, what, about $5 trillion worth of Treasury, something like that, 6 trillion, around there. Forget what the exact numbers are. I think it's maybe 3 trillion in mortgages and 5.5 trillion in treasuries, whatever. It's a lot. And just by buying those, you're trying to control the level of interest rates all along the treasury curve. So when they start saying yield curve control, to me, that's a signal that, hey, we're going to have to print more money. And that conversation started, a couple years ago before the market dislocation that we had in 2020. And so to me, it was just them it was the Fed's way of kind of signaling, hey, more QE's coming.
Yeah, because when you take a look at it, you do see portions where the yield curve is flattening, even some places where it's inverting. So when investors see these, the flattening and in places where it's inverting, what does it tell them?
The common narrative is that it tells us, oh, the Fed's making a policy error. There's a recession coming. They shouldn't be hiking interest rates. But it doesn't. It's not as meaningful as it would have been 20, 30 years ago because the Fed has basically removed most of the the price discovery power of the Treasury market. There's really no price. I mean, if the Fed unwound its balance sheet and stopped buying treasuries, and it hasn't stopped buying treasuries completely. They've been involved in treasury bill auctions the whole time, even up through and past the point at which they were supposed to stop buying treasuries. So, what would happen if the Fed stops buying treasuries and then starts unloading the treasuries? Even if they do it slowly over time, you're going to get a massive move higher in interest rates. So an inverted yield, if the Fed wasn't involved in the Treasury market, an inverted yield curve would have much more meaning than it does right now. But to the extent that price discovery has been dumbed down, yeah, I mean, I don't think, I think you'd have to be a total moron to understand that for most households, this economy's been in a recession for quite some time. And the Fed, with just 150 basis point hike in interest rates to a level that is still way below the historical average for the Fed funds rate, the Fed has caused a massive sell-off in the stock market, and the housing market is starting to collapse much more quickly than people realize. And that's with just 150 basis points. I mean, they haven't even come remotely close to getting the Fed funds rate up to a neutral level. And by a neutral level, I'm just saying let's use the CPI index measure of inflation as to what the inflation rate is. So, if you want to get the Fed funds rate up to a neutral level, you got to take it up to 8%. Well, imagine what happens if the Fed does that. Financial market apocalypse.
If you're enjoying this interview with Denver Dave Kranzler and I, please consider subscribing to our YouTube channel and giving us the thumbs up to let the algos know you want more content like this. Yeah, and if you want to learn more about systemic wealth protection, please do visit us at www.silverbullion.com.sg. Yeah, I'm not sure if we want if we want to imagine that, but we're seeing countries like China, Russia, Japan. They're not really buying as much treasuries. In fact, they may be even selling off treasuries. Do you think? Can you pick one place or point in time that made these countries not want to take on U.S. debt anymore, or was it just something over time they said we've had enough with the money printing?
I think that there's just a shift in the center of the world of finance. It's slowly shifting towards the Eastern Hemisphere, towards the Russia China consortium. And I mean, the, the Treasury market has been somewhat, artificial ever since we went off the gold standard in 1971, and the petrodollar was born. And both China and Saudi Arabia were recycling the dollars that they took in from selling us oil and the goods that China sells the United States, and they were reinvesting it in treasuries. And it was a way. I mean, it's in a way it's kind of a Ponzi scheme because it was a way for especially for China to start building its economy and growing out its economic system. And I think China. I don't know that China could necessarily function in prosperity without the level of U.S. exports that it's doing, but it's slowly been weaning itself off of that, and it's been expanding its marketplace into. I mean, there's all kinds of organizations that have sprouted up that have created economic development and consumer markets over in the Eastern Hemisphere and especially in Asia. So, and that, that process takes time. It doesn't happen overnight, and we're seeing it. And I think part of that transition is what we're seeing now. I think I read earlier this week, China unloaded in the first half of the year $100 billion worth of treasuries. I mean, that tells you, A, they're not as reliant on the US economy as they were at one time. And B, they realize that the dollar's depreciating. It's still depreciating, even though the Fed supposedly has stopped printing money right now. Because when you have negative interest rates, that in and of itself devalues the value, the dollar. And so if you're China and you're sitting there on $1.2 trillion in dollar reserves that are going down in value every day, it doesn't make sense to hold them. But they can't sell them all at once either, because otherwise, they'd be shooting themselves in the foot.
Right. Dave, the bond market very well. Junk bonds very well. Now, I'm not going to mention any names here, but can a nation 30 plus trillion in debt, and we're not even counting unfunded liabilities, can they be possibly selling the world junk bonds?
That's a great question because it's really an issue of semantics. I mean, the reason why the US Treasury paper has been considered the risk-free standard is because it's impossible for the US to default as long as it has the ability to print money unfettered and with no checks and balances. Compare that to the ECB. In order for the ECB to print money and so that each of its sovereign members can continue making their debt payments, you have to have an agreement by every party. So, that's just, Italy can't just go out and print euros in order to fund its sovereign debt. But the U.S. has been printing dollars to fund its sovereign debt since 2008.
Dave, recently we also saw headlines where the Ukraine central bank sold over 12 billion of its gold reserves during the war. What's your take on this?
Well, that I wouldn't take the headline at face value because there's any number of things that could have gone on there. And my personal view is that the nature of that transaction was merely an accounting entry. If you recall back in 2014 when the US effectuated the coup over there and threw out the previous guy and put in Zelensky and put in their guy. It was basically done so the U.S. could rape and pillage Ukraine rather than Russia rape and pillaging it. And it also gave the U.S., aka NATO, a military stronghold right in the underbelly of Russia and one of the most important port areas for Russia. But if you recall, at the time there were media reports about the U.S. military airlifting, and I thought I had recall the number 25 tons of gold, and that was basically, I think, what the U.S. gold or the Ukrainian, at least reported gold stock was at the Ukrainian central bank. So, I mean, that gold, assuming those news reports were accurate, and I see no reason why they're not, that gold was already removed from Ukraine. And so I'm guessing that the $12 billion credit that the U.S. is giving Ukraine for that gold was merely an accounting entity. So, but again, the truth around what happens with big piles of sovereign gold or big piles of gold, period, that are stored around the world. The truth about that is intentionally kept opaque. So, I don't know that anyone can speak with certainty about what the nature of that transaction really was, other than the deep inside parties that were involved with it. But I would probably put some money on my theory being the right theory.
'Cause I found it pretty interesting where, all of these countries were saying, they're supporting Ukraine, they're giving them financial aid and things like that. And then all of a sudden Ukraine sells their gold.
Well, I think it was considered, partial repayment for a lot of the money that the U.S. has sent over there. I mean, the U.S. has been by far the biggest financial supporter of the Ukrainian military effort over over there.
And also in the news, JP Morgan employees and spoofing the precious metals market. And this isn't the first time we've heard of spoofing or basically moving or let's just say manipulating the markets. What's your take on this story? And in the end, if found guilty, what kinds of punishments do you think will come down, if any?
The banks themselves won't be punished. They haven't been punished in any of these cases. And I forget when the first spoofing case was prosecuted. I don't know, maybe 8 or 10 years ago. I mean, I don't even really pay attention to these stories. A lot of people get excited about it. But if you look at what's really going on, what's happening is they're going after the desk traders. And the desk traders are merely following orders from above, right? Hey, don't look at me. I'm just following orders. But the people at the top are they're immune from prosecution, and the desk traders are the ones who are taking the fall for this. Now, I think because I skimmed through the latest allegations, I believe that the guy that they're going after that was on the trading desk is saying that he was instructed from his supervisor on how and what to do. So, we'll see if it goes a little further up the food chain this time around, but I'm not optimistic, and I would not even, I mean, I think it would be naive to base hope that this is going to expose the big manipulation scheme, this particular case. I think it's probably just going to be no different than all the previous ones that have been prosecuted. I think the first ones originally prosecuted were either like Deutsche Bank or Barclays or something. There's been several of these over the last several years.
Well, I guess since we're talking about manipulation, we got to talk about COMEX. Why do we see daily movements, buying and selling, or trading of precious metals that to some people, it's just not possible? And there's pretty clear patterns of manipulation, yet business as usual. Why doesn't anyone step in and take a deeper look into the COMEX and what's going on there?
I mean, who's going to step in and take a look at it? You got the fox watching the hen house. If you look at who the regulators are and who are on the boards and the committees of the regulators, they're all either former Wall Street people or they are, high level attorneys that were, had the biggest Wall Street banks as their clients. And so it's essentially a case of regulatory capture. I mean, it's no secret that the big banks have a huge, heavy hand in the legislation that gets passed with regard to the financial markets in this country. And it's essentially you've got the largest corporations in each sector of corporate America that are designing and paying for the policy to be implemented in our government, and it's the same thing in terms of regulation, enforcement of the regulations. I mean, when's the last time? I mean, throw aside Jeffrey Skilling and Bernie Madoff. When's the last time a high level Wall Street official spent any time in jail? You have to go back to Michael Milken. And he was eventually, I think, prosecuted and put in jail like in the early 90s or mid 90s. So, but since then, you haven't seen any of these big, Wall Street CEOs or anyone from the C-suite get prosecuted and spend time in jail. So that's what's going on. I mean, look at who the head of the SEC is, Gary Gensler. At one time, he was on the track to become the managing partner of Goldman Sachs, and then once it went public, to become the CEO. And I'm not sure exactly what derailed his track to the top. Probably Henry Paulson, because that's Gensler was one of Henry Paulson's sidekicks, but Gensler was put in to be the chairman of the CFTC back in the early 2000s, and he was chairman of the CFTC when gold was manipulated down ahead of the great financial crisis. And now he's the head of the SEC. So why he didn't do anything or look into anything back then? So why would he expect that? Why would we expect that these guys are going to do anything now? They're not, because the regulatory capture and the corruption and the enablement is even worse now than it was back during the first great financial crisis.
I just rattled off three entities where there are governments, there are bankers with their traders, and exchanges such as COMEX. Why is gold seemingly at the center of so many things where these entities are making huge profits off of gold, basically controlling the gold price? Is gold and silver the right place to be?
Well, you have to differentiate between paper gold and physical gold. And what you're talking about is the paper gold market, the derivatives market. And the derivatives, the paper gold market is many multiples the size of the underlying physical market. And the same thing in silver. And that's just looking at the COMEX. And then when you throw in LBMA forwards and OTC derivatives, I mean, the paper gold and silver market is an absolute Frankenstein relative to the underlying supply of physical gold that sits above ground, and especially relative to that supply of gold that's actually available to be delivered. And so what you're seeing every day when you watch the price go up and down is the machinations primarily on the COMEX, because that's the easiest paper gold market to manipulate. I mean, the COMEX in no way is a physical gold market. And the LBMA used to be pure physical, and now it's questionably a physical gold market. The physical gold trading has shifted over to Shanghai, and also now, believe it or not, Dubai. Dubai's been building up their presence in the global physical gold trading market. What I mean by that is when you contract on those markets via the futures or whatever they call their flavor of derivatives to buy physical gold, your intent more than likely is to actually take delivery of that physical gold and remove it completely from the exchange vaults. I mean, we don't really see that on the COMEX. So I've been saying for 15 years, if the COMEX, if the CFTC required the COMEX to keep the outstanding open interest in gold and silver futures to say 110 or even 120% of the amount of legitimately available gold and silver, physical gold and silver in COMEX vaults that can be delivered should the holders of those futures decide to stand for delivery. And that's the way it is in every other commodity contract, right? If you're shorting cattle futures, you're probably doing that for a little bit of speculation, and also the market makers are doing that to provide liquidity for the market. And there are speculators on the other side of that. But if you're buying cattle futures, you're buying that more than likely to take delivery of the meat of the cattle. So, but that doesn't happen in the precious metals market. On the COMEX, in any given delivery period, maybe 1% at most of the metal is actually delivered, and an infinitesimal percent of that is actually removed from the COMEX vaults. And so my contention has always been, if the CFTC limited the open interest in COMEX futures to 110% or 100, just whatever for the sake of argument, we'd see much higher prices for gold and silver right now, because you wouldn't have this massive overhang of paper gold and silver contracts that are used to push the price around. And it's not, I don't want to make it sound like it's just the banks. And the banks are spearheading the effort, and they're probably spearheading the effort on behalf of the U.S. government, because it's in the U.S. government's interest to keep the price of gold suppressed, given that the dollar is the reserve currency of the world. But the way that these hedge fund algos have evolved over time, and the way that they operate now, they're basically momentum chasing algos. And so if the banks want to really force the price lower, they might be the first ones to dump a payload of paper onto the COMEX and push the price down. And then these hedge fund algos jump in there and start selling even more. And I can prove that, because you can see that in the Commitment of Traders report, where the hedge funds over the last probably, I don't know, 4 weeks have gone from being net long paper silver to being net short paper silver, per the Commitment of Traders report. and they are now also net short paper gold. So that's the hedge funds. The hedge fund algos right now are doing most of the heavy lifting on behalf of the banks. But that's what's happening, and that's what you're seeing out there. And to circle back to your other question, I mean, yeah, if you don't want to worry about the volatility in the price of gold or silver, and you know based on all your homework that you've done that gold and silver are going to move higher in price, then just buy physical gold and safekeep it yourself. And you're not buying physical gold and silver as a speculative investment. I mean, you can have some small amount of speculation, especially now because gold and silver are so underpriced relative to every other financial asset. You're buying physical gold and silver as an insurance policy. And an insurance policy that, God forbid, hopefully we'll never need, but unfortunately I think we are going to need it. And when you do have it, it's like house insurance. You don't need house insurance until your house catches on fire. So you say, I'm just gonna, I'm just gonna ride the wave and not buy homeowners insurance. I don't have a mortgage, so I don't have a bank forcing me to do it. And then all of a sudden your house catches on fire. Well, no one's going to sell you that insurance. And that's what we're going to eventually see in the physical gold and silver market. Now, what people overlook, because there's been a huge influx of investors into the sector since 2008 and really since 2016 and 2018, what people overlook is that if you go back to when the bull market in gold and silver started, now I just take it back to 2001, for ease of calculation, and not to just try and cherry pick the bottom in gold, because that wasn't the bottom in gold. Gold has been the number one performing asset class since 2001 through now. Silver is, I believe it may have moved up to number two before the NASDAQ started tanking hard back in November 2021. Silver was number three, but I think it's number two. If you measure gold and silver versus the major stock indices starting in 2001. So, I mean, over a long period of time, gold and silver have been a terrific investment. But, how do you value the insurance component of owning physical gold and silver in your own possession? It's invaluable.
I just want to touch on miners a little bit here. Of course, miners are seeing inflation, they're seeing higher operating costs. What do miners do in times like this where things become a bit lean?
Well, I mean, we're not really in lean times for the miners right now, because really what happened in the mini bear market that we had from late 2011 to the end of 2015 is it forced producing miners to really become lean in their operating budgets and their cost budgets, and we saw that. And so, the cost of getting gold out of the ground and selling it, the cost of getting gold out of the ground is, even with inflation, is a lot lower on average than it might have been 10 years ago. So, or 5 years ago. And that's even with, the rising cost of diesel and a lot of the other equipment that go into, the other CapEx expenditures you have to make on an ongoing basis to keep your mine going. And let's just set aside the cost of finding the gold and developing the mine itself. I'm just talking about once that mine is developed, and if it was put into operation, because it's got a much lower cost of getting the gold out of the ground, including the ongoing sustaining costs, then you've got a mining operation that's extremely profitable. I mean, it's a money tree with gold at 2,000, but even with gold at, where are we now? Call it 1720. Even at 1720, if you're all in cost, including the ongoing sustaining costs, as say for gold, say it's 1,300 an ounce. I mean, you're still making, and that might not include the corporate overhead, but you're still making. And 1,300 an ounce is high for all-in sustaining costs. most of these gold mines have, say $1,100 all-in sustaining costs. So, I mean, you're talking about a 30% gross margin, and then an operating margin that's probably 20%. And that's a pretty damn high operating margin for an industrial heavy machinery operation. So, I mean, and we're seeing this in the numbers. I mean, even with cost inflation, the mining companies that have been reporting their numbers recently, they're still showing fantastic results. So, and when you think about it from their standpoint, the price movement on gold from 2000 down to 1720, yeah, I mean, it's percentage wise, it's somewhat meaningful, and it certainly eats into the potential profitability of these mines. But like I said, and like I just demonstrated, they're still minting money right now.
Okay, so still a good time for miners and still a good time to be holding physical. Dave Kranzler, before we wrap up, can you let the viewers know how they can follow you, your work, and possibly even contact you?
Sure, I'm on Twitter, and it's just search on my name, Dave Kranzler, and you'll find my Twitter feed. My website's investmentresearchdynamics.com, and there's at the top there's a couple of links to my mining stock journal and my short sellers journal with more information if you're interested in seeing what those are all about.
All right, we'll do. Well, I hear your dog barking. I think he wants to get out and play tennis, so we'll let you head on out.
Probably need to go for a walk.
Thanks, Dave. We thank you for your time, your insight, and I hope we can do this again soon.
Certainly, Patrick. Good to see you.
That was Dave Kranzler sharing his views on the economy and precious metals. For more info on Dave and his mining stocks journal and short sellers journal, please visit his website, investmentresearchdynamics.com. If you like this video, please give it a thumbs up, subscribe, and share to let the algos know you want to see more of our content. Audio-only versions of this interview can be found on iTunes and Spotify.